All right, I don't think we need to do an intro. You know what happened today. It was quite the sell-off today. Not everything dropped, so we're going to break that down. We're going to break down what happened and what we expect to see now heading into an important last 2 days of the week and into next week. Let's get started. Today is Wednesday, October the 24th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in. Welcome to you first-time listeners. Subscribe to our YouTube channel. Click that thumbs up icon and let us know you want us to keep doing these videos. Comment down below. Subscribe to me on YouTube for more content like this throughout the day. Join our community on Facebook. And also join our daily Market Outlook email list with that link that's popping out up there in the top right corner of your screen. All right, let's start off taking a look at the S&P 500 with the market forecast tool. You notice obviously we dropped down here, and that brought the momentum and near-term lines down. But you notice that near-term line still didn't come down lower than the low point of the near-term line on this day of the cluster. So, I mean, you can, whoops. Let's see here. Let's draw that. Add that drawing again. There we go. Let's activate that drawing, so now it's technically like that, right? And you still have this divergence down here with the higher lows on the near term line. You notice we did not get a cluster. The intermediate line did drop down below 20 again, and just to kind of give you an idea of how long the intermediate line can stay below 20 before it rallies back at the green line. So you come back over here to November 2016, we were down there for a little bit of time with an oversold cluster before we rallied. You notice, again, we had it over here. This is 2018. Again, brief dips below there with how bearish we were. You come to 2016 where we had the death cross, right, on the S&P 500. And we had multiple days here, one, two, three, about a week or two around that January expiration and then right before February expiration for a few days there. And again, that was the environment we were in there was different than we are now because we don't have the death cross right now. We don't have the 50-day below the 200, even if price is a little bit below. Here's the first death cross that we had, which was at the end of 15. You can see a few days, the intermediate line below there. So, I mean, even in the most bearish times, the point there, even in the most bearish times, it doesn't stay below 20 for very long. Here's another dip with a couple of clusters below 20 on the S&P 500 in 2014. And of course, go to 2013. There's a little bit of a dip here for about a week below with a cluster in there. So you can see how, now we have, go to just right now. We've had a few days during that drop. We're back down below it again. Most likely, depending upon how, if we do get an update tomorrow, how big it is, we'll most likely stay down there for another day or two because of how deep today's drop is. But you can see how significant it is to get an intermediate line as oversold as it is, especially considering we are broken below that 2700 low point. We broke below yesterday's low. We broke below that low point. If this is indeed not a fake out, right? If we don't close back up above 2,700, if not tomorrow on Friday, if we don't close this week back up above 2,700, and it's not a fake out, right? And we end up breaking that low and holding it, our next intermediate low point's this one right here at 2625-ish, maybe right around 26 and a third. That level, 2633. So, and then of course the big one at 2600 where we had a couple of touches from the previous declines earlier in the year. So that's where our lows are. So this is the first time in a while. See, even that intermediate low point there, you have to go back a few years to see the last time we had an intermediate low point, and that's the dark pink shading here, an intermediate low point below the previous one. Right, you have to go all the way back to the election, which was a really dire time, right? Remember how bearish we were overnight on the night of the election. That was the last time we dipped below the previous intermediate lows, and then we dropped down and then rallied, and then that sparked a year-long market sentiment run when we had dipped below that. So this is the first time we've dipped below an old intermediate low point. Again, just to kind of show you what a fake out looks like here, There's the drop. There's the low point that we dropped below my horizontal line, and you can see we dipped below for a few days, and then one day got right back up above it. So that's a fake out, right? And so we're dipping below it here. You know, if this is indeed a fake out and not a breakdown, then we'll get back up above 2,700. Like I said, if not tomorrow, Friday. If we don't close above 2,700, then we have, we have an intermediate low point. We have a new lower low point, which, like I mentioned, we haven't been able to say even prior to that. Has been a long time. It was 2015, 2016 when we had the death cross. Well, the Brexit also was a fake out, right, where we dipped below to a new intermediate low on Brexit and then jumped right back up within a couple of days. You can see that here. Dip below that low and then a few days, boom. That was another time of a fake out below an intermediate low, only get right back up above. 2015-16, that was the last time. So you'd have to go back to 15, and then we'll go to like March of 2016 here, and look at on the daily basis. There's the last time we got to a low point, new intermediate low, and then stayed down at the end of 2015. And we rallied back up, but then double bottom, and we rallied back up here, formed a higher intermediate low point, and then we formed another lower low point, and then the divergence there with lower lows and the higher lows, long lower shadows, and all of that, and that sparked that Remember, that rally was led by international stocks. As big of a market we had in 2016 and 17, it was led by international stocks, coming off of significant lows, very similar to what we're seeing right now with international stocks. As bearish as the markets were here, they were one of the least bearish markets across the globe. Again, similar to what we're seeing right now. When you look at the Dow Jones Industrial Average, it has not formed a new lower low, so it's a little different. And now this low wasn't as high, right? The S&P had a much higher low point here in June. So we're not down to that 24,000 level, which is significant for the Dow. And you can see the NASDAQ Composite, it is below, right? We had the fake out here. We were testing it, and today again, if we don't get back up above 7,400 in the next day or two, then that's going to be a new lower low point. And the last one before that's going to be down here to 7,000. And of course, the Russell 2000, it's breaking below. It broke below these low points. It already had done that intermediate low point. And this is the significant one at 1,500. And so there's your fake out breakout, right? If we break down here and hold that breakdown below 1,500, or more like a little below 1,500, then we have a change in trend, right? Now look at all these clusters. Again, we have not had this many clusters in such a short amount of time, literally since March 2009. That's how much of a sell-off we've had in the Russell 2000 versus, say, like the S&P 500. You look at from the high point we had at 1742 to today's close, essentially, which is the low point, it's a 15% drop. And from high to low in the Russell 2000. So, it's small cap stocks are almost in quote unquote, bear market territory. All right, when you look at the long-term view and you can see, okay, well, there's 2015, 16, the last times we had, lower intermediate lows, but see how we have been grinding down for a while. We've been grinding down pretty low here. We've had a couple of significant peaks with that divergence here. The target of that divergence is that 2,600 low point that we had, the low in between here. So those are big highs coming off of a protracted decline that we've had since 2017. But again, like I mentioned before, 2730 is the 200-day moving average. So we might not close above that by the end of this week if we only get above 2,700. But if we close above 2730, the 200-day moving average next week, then that's going to be your bullish sign that this is a fake out. And otherwise, if we hold this breakdown, similar to what we see here, we had the breakdown here in 2015 in August, and then we stayed down. That's when the death cross comes, right? And again, that's usually at the end of this kind of a protracted decline towards zero, and we are, we've had a protracted decline absent these top two peaks that we'll see. So we'll see. Now you notice too with that we didn't get very much lower. We got a little bit here in 2015, but kind of set the low, and then we double dipped down a little bit lower in early 2016 before sparking the rally. And remember too that was, international stocks had, especially in China, had been falling. In fact, China was down 50% from high to low by the time we hit that that early 2016 low. So very similar circumstances now to what we're seeing here. Again, if we hold this breakdown below the 200-day moving average, you can see the Dow is just sniffing it. The NASDAQ Composite's a little bit more below it. And then the Russell 2000, of course, has broken down and, is really now kind of holding that. And let me show you what that looked like in 15-16. So there's the breakdown, initial breakdown of the 200-day moving average. You can see how we were already relatively low. In fact, we had come down from a lower low and broken down to these low levels. So again, a little different here in that we were at a much higher peak for the Russell, momentum-wise, long-term momentum-wise, than we were even there. That was a lower high point coming off of this much higher peak. So a little different circumstances on the Russell, and again, just shows how again, we haven't had a sell-off like this in small cap stocks since that '09 period right there. This drop, that decline over that small period of time has produced as many clusters now as we're getting. We've almost produced as many clusters now as we did back then. Let's look at the 3 green arrow chart. And you can see 3 red arrows again. And you'll notice here on the MACD, let's go to the 2-line versions for the S&P 500. That's right here. You'll notice, so our MACD dropped. The stochastics hasn't dropped to a new low, but the MACD itself did. And this is, again, the 8-day below the 17. That's what that blue line measures. The orange line is the moving average of the blue line, specifically a 9-day moving average. If I were to show you, let's change the MACD and look at today's price relative to the 8-day exponential moving average, the first input on the MACD, then you can see, we dipped down here as low as we did back in February. We jumped back up towards the 8, which brought the MACD to 0. We dropped all the way back down, so far as of right now, a higher low point compared to that lower low. And again, if you look at the price compared to the 30-day moving average, right, the one in blue up on the screen, dark blue up here, you can see again how much further, we did get a lower low. And then, of course, the 50-day moving average, which is another significant time frame for a moving average, you can see hit OK and hit OK. So, oops, didn't take. Try this again. Oh, I'm hitting the wrong one. So this one, 50. Okay, so now that dark blue line up there is the 50-day moving average. This one here, so again, we are further below the 50-day moving average now. In fact, we have to go back a ways. And I saw a data point on this on Twitter. We have a lot of stocks that are significantly below the 50-day moving average. I mean, look at this. This is how far the price is below its 50-day moving average on an absolute basis. It's been a long time. That just kind of shows how significant the sell-off is. Really, it's been since that 2015 drop, that August 2015 drop there. That's the last time we were this low below the 50. And you can see you hit a low point simply because you run out of sellers, right? You run out of sellers, at least in the short term. That might come back in before, and they even come back in a little bit later in 16 if you give another catalyst. But that's remember the seasonality. Even with that decline that we had, when it got to the seasonally bullish time of year, they held up before January, which is typically a bearish or not as bullish time of year. That was different this year, but normally not nearly as bullish. So again, interesting to see how deep below the 50-day moving average that current price is. Again, shows just how extended we are. All right, now if we take a look at the intraday chart, lower high, lower low point. You can see all the volume coming at the very end. That's where that late sell-off kind of lasts. we broke below yesterday's low, and that's a big amount of volume coming in to push us to the lows at the end of the day. So significant to get that. And again, not from a bearish standpoint, but from a to get that, if we would have held right at here at that low, that actually probably would have been more bearish than breaking down with the extreme amount of volume at the end. You would have expected another day of selling if we would have kind of stayed here steady and closed at the low of the day, or maybe a little bit lower. But the extreme amount at the very end, and you can see now we have almost a 20-point wide spread in the 4-week range. Again, for context, let me show you context here. 20 points is, less than 10%. 26.5 is the we had 18 points, 93 to 65. So that's less than 10%. A little bit more than 5%, probably 7 or 8% or so. Let me give you some context of 4-week ranges. So let me go back to a daily chart here, and we'll go over here. And you can see, from that high point, we hit 284, 286 to that low point of 252. That was over 30 points. So that was a much bigger range. And then as time passed, this high point at 280 to that low at 263 is about 17-point 4-week range that we were muddled around in the lower half for a while until we kind of broke out finally to the upside. So this is a wide range that we're in right now for a 4-week period, similar to what we saw over here. And of course, if I were to go back to the 2015-16 time frame to where we're over in this area, here, let me do this instead so we can see it a little bit better. So I'm going to go to the custom time frame, and we'll go to the middle of the year in 15 to the middle of the year in 16. So that will capture both those dips. There we go. So that initial drop in 15, you can see for a good period of time, the high was at 210.68. The low got down to 182. So that was an 28-point range on 182. So that's a really significant, almost 20% range. Shows how bearish that was. And then you had a high here at 207.79. And a low of 19 points plus that 26-point range, and we're at 185. Again, well over 10% range. So we have a wide range right now. It's not near as wide as it was, as we've seen in previous periods. So it kind of puts in again, why were those so big? Because the 50-day was below the 200-day at both those levels. We broke down there. The 50-day crossed below the 2. We held that breakdown to a new intermediate low point. The 50 crossed below the 200, and we really pushed down lower. So that's what you watch for now to see if we get something similar happening. If you look at the trading range and the volume today, the trading range is 9 points, so almost well more than double the regular ATR right now. The average of the volume was at 177 million, so just underneath this, barely. Just smidgen below that 1.5 times mark, but same level of volume that we had in these days, especially this day right here. So pretty strong volume and extreme trading range. You put those numbers in context, 177 million, that's going to be off the chart, and 9 points obviously is off the chart too. And these numbers are getting bigger, right? Which, again, the bigger they get, eventually they roll over and start, longer upward trends. And again, for an example, for context, I'll keep showing you the 2015, which you can see again, this is ATR, so 4 points. And keep in mind, we were 4 points on 190 versus 4 points on 265, so not as high, but you get the idea. And then you can see the peaks in all of these, and what happens after they peak, right? And what we expect to occur eventually here. Let's take a look at the volatility. Interesting that the volatility index did not have the extreme move that we've seen before. So it did jump up here at the end, it got up to 26 at the very, very end. So big jump higher, but not to 1.15, which is where we got to at the worst possible day. So we closed the VIX here on October the 11th at 25.73. We closed here at 26.04. So we actually closed higher on the VIX now than we did on October the 11th. But compared to VXV, we did not. We closed a little bit lower. So not, from that standpoint, not nearly as extreme now as it was then. Divergence, that's a divergence pattern. I also want to show you this chart. This is the trend. The trading index is what it's abbreviation for. It looks at advancers versus decliners, as well as volume for advancers versus volume for decliners. And so again, if you're in a neutral market, your volume for advancers and decliners, the ratio should be similar to the number of stocks that are advancing versus declining. So the volume should line up, right? If you get more volume on your decliners than how many stocks are actually declining versus advancers, then you get this big number. And again, the big numbers, these spikes in numbers, can be, show extreme sell-offs. Now you'll notice here, so this is earlier this year was the other time we got this extreme move, and we got it again on the second low in April. You notice for most of that, drop. In fact, if you take a look at here, let me detach this. I'm going to detach this chart. I'm going to have it just kind of off to the side right here, and then over here I'm going to pull up the S&P 500 again. Oops, S&P 500. So you can see here. So we started the drop in January 26 is when we peaked. So January 26 is right in this area. So you can see we had some runs right there. So we had some high volatility moves, but not until February the 5th, which is this move right here. Well, this one right there. February the 5th, that was the big jump higher. And you notice we kind of messed around again. And then again here in the end of March, that is this one. You can see we were jumping above right around 1.5, which is seen as an overbought level for a really extreme level to the upside for this index. And when you get up to 2, you don't get up to 2. That's the surge, right? That's the extreme flush surge. You don't get that. You can be above 1. You can be at 1.5, 1.5 during the selling. But then you get the 2, and then you get that divergence, long lower shadow, and we bounce, right? We had the flush there. Same thing over here. We got above 2 on April the 2nd, and then on April the 6th. Well, and really, again, over here, we got close. So we did 2.11 on 322. So there's 322 right there. Then you have April the 2nd right here on that day, and then April the 6th there. So, you see all 3 of those days that we had such extreme levels, not just at 1.5, which is typically bullish or overbought for this, but the extremes, that's, it's hard to go much further below that. And you can see, we were up above 2 today. And if you finish at the highest level that we've seen since back at the end of May. And even if you look at the last intermediate low point we had at the end of June right here, so we peaked on June the 12th, and then towards the end of the month you can see, so here's June the 12th right here, and you can see we were at 1.5 for a long time, and then at the end of the month we got the jump up higher to this high level, even on just an intraday basis. That was the flush, and then from that point on we rallied, right? And so we haven't, this whole sell-off right here, if you notice on the trend, we have not had the move up to above 2. I mean, we on an intraday basis we were on 10.12, but we didn't close up above to 1.5 this whole time until today. Today is the biggest extreme amount of selling that we've seen out of all of these days. And again, in the past, again, especially as far below the 30 as we are, as far below the 50 as we are. Not that we'll bounce up to 2,900 right now. But you do have some divergences that sets a target at 2,800, and then 2,700 is the level for the fake out. Those are key levels to watch for in the next couple of days for 2700 and 2800 over the next probably 10 days or so. All right, so now we transition to what's driving this action, and again, the big driver of a lot of this is not the U.S. related. I mean, yet this is the weekly charts, mind you, for all these foreign markets. You can see Brazil's the only one that's bullish. It's got a rising intermediate line, but it's only at 40. The U.S. intermediate line is still the highest value on the weekly chart out of all of these. So this isn't, you can see its moving average is actually green, or yellow, excuse me. We're below it. But it's still rising. The rest of these, red, 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 red. A little bit of yellow because we're back above it, but it's still falling. Here, we're yellow. We're below it, but it was rising a little bit. It's probably going to turn down now to red next week. Red there and red there. This has been an international sell-off, more so than a U.S. sell-off. And you can see a lot of these international areas. I mean, these are 3-month returns. Just for context, here's the S&P 500. Some of these aren't loading up for some odd reason, but a lot of these, Argentina, Turkey, are way down here at the bottom. You can see there's Germany, 15% 3-month return. India, 16%. Italy, 16% drop. There's Mexico. France, down 12% in 3 months. There's China, down 10% in 3 months. And there's the U.S. down a little less than 6%. Now, that's about 6% was about the number we dropped down in February when we were at the lows of a 3-month loss. Not February, in March when we double dipped. Right, that was our 3-month losses when we got down to 6%, and we weren't able to go too much lower. The long-term average 3-month return for the S&P is 2.2%. So it fluctuates, right? Because we were just at 6% for gains. So that will fluctuate. In fact, you can kind of see here. Let me go to 1 year to the green arrow chart here, and all the way up to October the 3rd. If I were to do a custom chart here on October to October the 3rd, right there. Oops, sorry, I need to do the daily chart. Well, it always defaults to an hourly. But the 3-month return as of October the 3rd was 6.9%. So we just flipped the script now to being down. And again, that's about where we were when we were down here. See, in April the 2nd. Let's change that time frame. Nope, I keep hitting buttons here. To April the 2nd of this year at the lowest point there. April the 2nd, there we go. And then we'll go back to a little bit further in time here. And so there's our 3-month return to the downside. Actually, it was only down 4% at that time. We'd have to get down. Let's get down to, let's see, it'd be April the 26th. Let's get to April the 26th here. And bear the piano with me on the piano upstairs. Here we go. This is the lowest. We're going to go to the 3-month period. Coming from these highs, we were down 6% at one point in time. The 6% of a move drop, and again, that's about where we're at right now, and that's where we were coming off of these lows. So that's a big number for us in 3 months, and you consider the rest of the world is twice that or 3 times that or more when you look at some of these others that aren't loading up right now that are down at the bottom. So this has not been a U.S. sell-off. This has been a international equity sell-off that the U.S. has been finally invited to really, really quickly over the last couple of weeks. And again, the quicker the selling, the better, right? It's those protracted sell-offs, right? It's the 2015. Right, it's that period when you have that, when you kind of go down and stay down for a while. That's the worst, right? That's when you get the death crosses, and we can stay bearish for a while. The quick sell-offs that happen over a couple of weeks, 1 or 2 couple of weeks, those are the better ones because, and you can see this one really has been over 2 weeks spread out here, with one last week, kind of a flat week in the middle. Now, the other issue that's been blamed is the yields, right? The rise in the yields, making their breakout above this 3.1%. And you can see over the last couple of weeks, coming down from that 3.25% peak that we hit, and now rolling their way down. coming down itself from a lower high point. Now again, you remember these long-term yields, more economic growth dependent more so than inflationary, especially when you look at the 30-year yield, right? The 30-year yield, which is still holding up very, very strongly after its breakout. So that's okay. It's okay to have rising yields, even if the market gets spooked originally by it. But remember, we've been holding up compared to these international markets for so long that it seems like we've caught up in a couple of weeks to what is our equivalent significant downward number. And remember last time we had all those weekly clusters on these international stocks, they led us back up. So again, that's actually what I expect to happen here is these international beaten up international areas that make this drop that we've had look like nothing. I expect though there be a lot of value opportunity there to lead us back up again, like we saw, as I mentioned before, like EFA taking off from early 2016 all the way through, and then of course EEM even more so, by EEM 2016 leading us higher. So those are the areas. You see how much further down we were by the time we got to our death cross in August. EEM was already had its death cross, and so did EFA. Had its death cross earlier, it finally caught up to us. It had a death cross earlier that we didn't have, but August. But EEM was the one had a lot earlier, and all that weakness finally caught up to us then, and it appears to be the case again now. If you take a look at the sectors and how they're moving, you can see this is their weekly charts, 3-year charts here too, and you can see which ones are really getting hit the worst. It's energy here with multiple clusters in the last 4 weeks, materials getting a cluster finally this week, and then industrials, which is, where did industrials go? Over here, breaking to a new low there. Again, those are the areas that are dollar sensitive, right? That are currencies very similar to international areas. You can also see some of the big winners previously, discretionary pulling back, similar to the S&P, technology pulling back, and healthcare pulling back, but still on strong upward trends and not breaking the new lows yet. Again, very similar to the broad index. So all these areas are getting pulled down. You can see even financials too, despite the yields breaking out. Financials did not break out to new highs and breaking down to new lows. But it's those dollar sensitive areas aligned with the weakness that we're seeing in these international areas. They're the ones that have really dropped us down the most. In fact, over the last 3 months, there you can see materials down 15%, energy down 12.5%. There's your industrials. And then up here at the top, your utilities and staples are actually up over the past 3 months. They're up today along with real estate. So not everything was down, and you've got these safe haven areas, these interest rate sensitive areas that are benefiting from this brief drop we're having right now in those long-term rates. All right, not everything participated in the bloodbath today. As you can see, some stocks, especially in the utilities area and consumer staples, both actually rallied pretty hard. I mean, look at Duke Energy here, kind of in a sideways range in this big volume area for so long, and then finally breaking out today, big breakout today, above the Bollinger Band. If you take a look at it on some of these other charts here, Duke Energy, you can see the intermediate posture now is almost strongly bullish with the intermediate line coming up, and you can see near-term line hasn't gotten into the upper reversal zone yet, again, which is not surprising considering the environment that we're in. You look at its long-term charts, breaking up above. We had the golden cross, we retested the 200, and now we're breaking up above making our way up again, similar to this, where you break above, you get the golden cross, you retest the 200, and then you make your way higher again. You take a look at the DMI. We saw the Bollinger Bands already, breaking above the upper Bollinger Band. Here's your DMI with the negative line dropping down here below 20. Positive still easily up above 25. Strong bullish trend, and the trend's got room to grow with that ADX line rising up. And of course, from a 3 green arrow standpoint, we'll look at on the 3 green arrow chart, we have 1, 2, 3 green arrows. Not quite the spike in volume here, but again, in this environment today, kind of hard to get 1.5 times the average volume to the upside. So we'll keep our eyes on, again, fake out versus breakout, whether or not we're able to hold this breakout. So we can do an easy bullish trade here, selling. Now you have to keep in mind these are relatively wide spreads of the market closed, and we are a little further out because it doesn't offer weeklies here. So you have to kind of maneuver and see where you can get filled in here in the middle of this price. The natural is obviously at 55 cents. You would like to get at least 58 on a $2.50 wide to make the risk worth it. And again, 82.5 is right there at this old high point, right there. So it's basically says we either hold this high point or we don't. If we don't, we take the loss. If we do, we ride this up. So quick little easy bullish trade in an area that's bullish and has been breaking out and is benefiting from this drop in rates. In a lot of these areas. In fact, if you look at just the sector as a whole, XLU, you can see a lot. It's even breaking out above recent highs and making a run. Here's a chart of the relative strength using the RSI, which again is getting up to these bullish levels that we haven't seen on a weekly chart in a long time, getting the golden cross and the 50 to 200 day moving average with that MACD, which has been steadily rising, now finally crossing above zero. This is again the relative strength of utilities as staples. So there's opportunity here, at least in the, while we're still kind of figuring out this high volatility and figuring out this low point, to take advantage of one area that's holding up really, really well on a relative basis. So that wraps us up for today. Quite the day today. As always, love to continue the chat in our forums. That link that popped out there in the top right corner of your screen, click that link to continue chatting about tonight's market outlook on marketscholars.com. Thank you again for watching. This is going to be an important couple of days to finish the week, Thursday and Friday, especially with GDP coming out Friday morning. So stay tuned so we can see how the market responds and how we'll respond with what the price is showing us. So remember to subscribe to our YouTube channel, click that thumbs up icon, comment down below. Also, follow me on Twitter for more content throughout the day, and join our community, our Market Outlook community that we created on Facebook. As always, have a great evening, everybody, and we'll see you all tomorrow.